Capital market stocks like BSE, Angel One, CDSL are crashing, down up to 9% even as Sensex holds flat. What triggered this shock? And what should retail investors do now? Stay tuned. And hey, if you're serious about staying ahead in markets, hit subscribe. You don't want to miss our real-time breakdowns. Hey everyone! Today, we're diving into a sharp sell-off in capital market stocks. Despite Nifty, Sensex barely budging. Data point, FortuneIndia.com reports BSE, Angel One, CDSL plummeting up to 9% amid F&O concerns. Let's talk about the core reason why capital market stocks are crashing right now. SEBI's crackdown on Jane Street. On July 3rd, SEBI, India's market regulator, issued an interim ban on Jane Street Capital, one of the world's biggest proprietary trading firms. The charge? Alleged manipulation of the Bank Nifty and Nifty derivatives market. What exactly did Jane Street do? According to SEBI, Jane Street was running a classic pump and dump operation. They allegedly bought aggressively in the morning to push the index up and then shorted it later in the day, profiting from the decline, repeating this across 18 expiry sessions. This wasn't just a one-time offense. SEBI claims it was a systematic strategy to distort prices, which violates India's securities laws. As a result, SEBI has barred Jane Street from Indian markets, frozen over 4,300 crore, around $567 million in their accounts. Immediate impact. The market didn't take this lightly. BSE shares fell 13% in 3 trading days. Angel One, CDSL, Nuvama all saw heavy declines. Why? Because these stocks are deeply tied to the F&O, futures and options segment. And this crackdown caused fear that SEBI will tighten F&O regulations, reducing trading volumes and brokerage revenue. Essentially, SEBI's actions sent a shockwave through India's capital market infrastructure, and investors began dumping anything related to brokerages, exchanges, or derivatives clearing.
Now let's break down the sector-wide damage. And it's not just BSE feeling the heat. Here's the scoreboard. Angel One is down 6.4%. CDSL dropped 3%. Nuvama Wealth slipped 1.8%. All this in a single trading session. Why? Because these companies are tightly linked to futures and options, F&O, activity. Think of F&O as the lifeblood of revenue for these players. When liquidity in the F&O market dries up, either due to regulatory fear, lower volumes, or reduced leverage, brokerages and exchanges make less money. Less trading, less brokerage fee, falling profits, sliding stock prices. Investors know this. They are reacting not just to SEBI's action, but to the potential domino effect on trading volume across the ecosystem. In fact, analysts are sounding the alarm. One expert quoted on hcsky.com said, "Markets are now assessing the impact on F&O volumes and pricing in that risk." This ripple is why stocks like Angel One, CDSL and Nuvama are in the red, despite having no direct role in the Jane Street incident. It's contagion by association. So even if the index is stable, the derivatives-linked business model is under pressure, and investors are adjusting fast.
Now here's what's really interesting. Despite the sharp sell-off in capital market stocks like BSE, Angel One and CDSL, the broader Indian market has remained surprisingly calm. Just look at the numbers. Nifty is down only 0.04%. Sensex slipped barely 0.02%. So why this disconnect? According to Reuters and Times of India, the broader market is being cushioned by global optimism and selective buying in banking and IT sectors. Yes, there are some tariff jitters, especially with talk of the US raising import duties in August, but so far, investors believe it's not enough to derail the entire market. But here's the dichotomy. The crash is not market-wide. It's sector-specific, focus on capital markets and F&O heavy stocks. Why? Because only that corner of the market is directly affected by SEBI's crackdown on Jane Street, fear of tighter F&O rules, falling derivatives volumes, Think of it this way. The rest of the market is calm, but there's a fire burning in one room of the house, and that's the capital market segment. Investors are staying invested in stable sectors, but they're fleeing anything tied to derivatives and trading volumes. This is a classic case of divergence, where one sector suffers sharply while the rest of the market stays composed.
Let's zoom out and look at the macro level pressure hitting investor confidence right now. First up, global trade tensions. US President Donald Trump, who's leading in the polls, is once again pushing tariff threats, especially on imports from countries like India and China. He's hinted at massive new tariffs, possibly rolling out by August 1st. According to Reuters and Economic Times, these statements are already spooking global markets, including India's, because tariffs mean slower exports, disrupted supply chains, higher input costs. And it doesn't help that we're in what Deutsche Bank calls a summer vulnerability window. Historically, markets tend to underperform during summer months due to lower trading volumes, lighter institutional flows, and heightened macro noise. Add to that the weakening rupee, now hovering around 85.85 to the dollar. That makes imported goods more expensive, raises inflationary pressure, and spooks foreign investors who may worry about currency losses. So, while SEBI and F&O headlines are rattling the capital market sector, this broader macroeconomic tension is adding another layer of stress, especially for foreign investors and large institutions managing risk. Let's now talk numbers, because the retail investor impact is both massive and alarming. According to SEBI data, Indian retail investors lost a staggering 1.05 lakh crore rupees in the derivatives market during FY25. Yes, that's over 100,000 crore rupees, gone in a single year. This stat, reported by Fortune India and Times of India, has become a wake-up call for many small investors, especially those playing in the high-risk F&O segment. So what's happening now? Retail participation is pulling back sharply. People are either booking losses and exiting or avoiding fresh trades altogether. This pullback is having a direct effect on companies like BSE, Angel One, Nuvama. Why? Because these companies make a significant chunk of revenue from retail F&O activity, brokerage fees, clearing charges, and so on. Less participation, less trading volume, lower revenue, stock price pressure. And it's already showing. Angel One shares down, BSE underperforming for days. If we plot a line chart of retail F&O activity over the last 6 months, you'd see a steep decline, post-March 2025, exactly when SEBI started clamping down and losses mounted. Bottom line, retail traders are bruised, volumes are down, and capital market platforms are feeling the pinch. This retail retreat is one of the most overlooked but powerful forces driving the current sell-off. Let's now decode what's happening with F&O volumes and open interest, the lifeblood of India's capital market ecosystem. According to Economic Times and NDTV Profit, open interest in Nifty July futures has dropped by 1.4%. But what does that really mean? Open interest refers to the total number of outstanding derivative contracts in the market. A drop in OI suggests that positions are being closed faster than new ones are being opened, a clear sign that traders are pulling back. This decline signals two major concerns: lower participation, especially from retail and high-frequency traders; higher volatility risk, because a thin market can amplify price swings. Now here's why this really matters. For platforms like Angel One, BSE, and Nuvama, F&O trading volume equals revenue. Every time someone places a derivatives trade, brokers earn brokerage fees. Exchanges like BSE, NSE earn transaction and clearing charges. So when F&O activity drops, their revenue takes a direct hit. And that's exactly what's happening now. Less volume, less income, falling investor confidence, sliding stock prices. Bottom line, a 1.4% drop in OI may sound small, but when multiplied across lakhs of contracts and thousands of traders, it's a major red flag for capital market businesses. Let's now talk about a very important market behavior: divergence. On one side, you've got the broader indices like Sensex and Nifty showing signs of recovery. Why? Because investors are putting money into safe, high-weighted sectors like banking and IT. These sectors are seen as defensive during uncertain times, and their strong quarterly results and institutional buying are propping up the index. But here's the twist. When you zoom into the capital market segment, stocks like BSE, Angel One, CDSL, Nuvama, you'll see they are still under pressure. Mid-cap and small-cap capital market stocks are down around 0.3%, while their large-cap peers struggle even more. Why? Because investors are still worried about SEBI's regulatory crackdown, falling F&O volumes, weakening retail participation. So what we are seeing here is a classic divergence. Fear in one sector, capital markets, opportunity seeking in others, like banking, IT, FMCG. It's not that the market is uniformly weak or strong, it's that capital is rotating, flowing away from riskier segments and into stable, earnings-heavy sectors. This divergence shows us where investor confidence is intact and where it's been shaken.
Risks and possible triggers ahead. Rise in global tariffs by August 1st. And SEBI crackdowns or policy shifts in F&O leverage. Possible rupee depreciation. Bond yield uptick. Trader and investor takeaways. Avoid knee-jerk exits. Not all segments are weak. If you hold broking or exchange stocks, review exposure based on F&O risk. Track SEBI orders for deeper regulatory impact. Use hedging products to manage rupee trade shocks. Quick historical lessons. Refer summer F&O volatility patterns, past examples. Mention how previous SEBI actions led to short-term dip and recovery. Suggest monitoring retail involvement and FII. Wrap up with personal strategy. In short, the crash is mainly due to regulatory shock in derivatives, tariff fears and F&O volume drop, not panic across markets. Personal view. I'm trimming exposure in brokers, watching tariff news closely, and reallocating some capital into stable large caps. What's your move? Holding, cutting, or hunting dips? Comment below. Like if this helped. Subscribe Finance Seco India for daily market updates and share this with friends playing in F&O.